recommended changes as Gordon made in his budget speech of 2013, sorry, where he recommended that the flow-through vehicles don't apply to trust anymore. There's no longer those flow-through aspects, that income and capital gains tax must be taxed in the hands of the trust at the trust level before distributions. This is still under consideration by Treasury. They've put it on the back burner, and we'll see how things go. Also, to protect your assets, I've covered that aspect. There's succession planning for your beneficiaries. If there are minor children involved, you must have a trust, because if you actually give monies to minor children, remember it can't go to them. Minors mean that below the age of 18. It must go into the guardian fund, and you would hate to put your money into the guardian fund, because you formally have to apply for the money to get it, to receive it. You have to, and we're not sure, you know, the kind of fraud, etc. we hear about. We would hate to get involved into that space, but the idea is you want protection, so the money for minor children will come into your trust, and it must be managed by the trustees. There's continuity. Trust can run for generations, and also there's cost savings. When you die, that property that I transferred to the trust, it's not mine. It's not in my estate. It cannot be brought into my estate. So you're saving capital gains tax, because when you die, you pay capital gains tax as well, not only estate duty. You don't have to transfer the asset. It can stay in the trust. You don't have to pay executors' fees on that particular property. What about local against offshore trusts? Now, as far as offshore trusts are concerned, the local trusts, we discussed that aspect and we spoke about all of it. The setting up of those trusts, in South Africa, we have formal registration process. As far as the offshore trusts are concerned, there's no such formal registration process. We call them confidential trusts. We call them blind trusts. In other words, you can call them the blue blind trust, and nobody will ever know who is the settlor and whose trust it is. I think it's quite important that the letter of wishes are terribly important, because you're going to be instructing the management company of that particular trust, it's the trustees, exactly what you want done in your trust. So that is left in their hands. You indicate to them, I have beneficiaries, the following people, my sons, my daughter, my wife, my husband, whoever it is, and ideally when I die, you want this thing to be distributed, they want them to have certain rights and so on, and you give the letter of wishes, which is in a way morally binding upon those trustees to follow those principles. Criteria for selection of offshore trusts, the jurisdiction and the protector. I think it's quite important to have these trusts in places where you feel safe. Remember, we're talking legitimate money here. We're not talking about money that you have offshore, which you haven't really declared. You're not supposed to have those kind of things anymore. As you know, in 2002, you cleared all that, and now you only have legitimate money we're talking about. You don't want to have sleepless nights. I've had clients who have passed on, who family members know that they have accounts, and I don't actually want to mention any jurisdictions, but in actual fact lost the money. They know that there was 2 million rand parked off in a particular bank account, and because it was so secretive, when the family went along to go and say, we want the money, they says, no, there's no money. He's taken the money a long time ago. There's no money. So you don't want that situation. So the choice of a management company is important. There's risk involved. But if it's legitimate money, then you don't have a problem. There shouldn't be any risk. There are costs. To set up an offshore trust will probably cost you about £2,000 to actually set it up. To run it, there are costs involved. Don't be surprised if it costs you 30 or 40,000 rands a year just for them to administer it. And they do nothing. I can promise you that they do nothing. But those are expensive to actually manage and run. Why do you set up offshore trusts? Perhaps you want to save estate duty. Yes, the same principles apply. You don't want to have all your eggs in one basket. You don't want to keep it in South Africa. But what is most important and what you seriously need to consider is the rand hedge. It's very nice to have all these assets in a trust. But if at the end of the day, if it's all in South Africa, it could become worthless. Who knows? We don't want another Zimbabwe situation in South Africa. So I think clearly those are the kind of things that you need to consider. Also, you don't want to have a situation, it's sitting as $1 US dollar is to 10 rand. In 10 years' time, what is it going to be? Could it be 1:5? Could it be 1:40? So you don't want to have a pile of rands which are worthless and useless. We don't want to have a Zimbabwe situation here. So perhaps you need to risk diversify, certainly from a rand hedging point of view. The questions that you need to ask yourselves as far as trusts are concerned, have you formed a trust? where you own assets that grow in value? Have you arranged for a trust to be formed in your will where you have minor children? Do you want the benefit of protection of your assets? Do you want to split income and save taxes? Do you want a succession plan for your family? Have you reviewed beneficiary nominated in your insurance policies? Do you want to save capital gains tax and estate duty when you die? Okay, again, the same principle. If you answered no to two of these questions, then clearly you need to seek help. Wherever you get that help, that's left up to you. I do want to take a 5-minute break, so let's just take a 5-minute break. I am running late, but we'll consider that. Age at which you start to earn income, age at which you start to save. There could be a big gap between the two. You're not supposed to have a gap. The moment you start earning income, you should be saving, but many people don't do that. How much you save, how long you save, your lifestyle, your health, your life expectancy, your asset allocation, which we discussed. When you're young, we said, remember, you should be in risk capital. As you grow older, you're supposed to move to the left, and your money should be, by the time you get to around about 60, it should be in savings and fixed deposits where you're getting fixed income, but you don't have sleepless nights. Okay, now pension, provident, and retirement annuity fund, the benefits and tax implications at retirement. Let's just take a typical simple example. I'm now retired from a retirement annuity. I'm going to get 1.5 million rand. I'm allowed to take up to a maximum in terms of the rules of the retirement fund, take 1/3 in cash. So I'm allowed to take, in my example, 500,000 rand in cash. That cash amount that I, excuse me, that I take, sorry. The 500,000 rand that I take in the form of cash, up to 500, it could be 300, it could be 400, whatever amount it is. That, from a tax perspective, I'm entitled to take that money tax-free up to 500. Anything more than 500 that I take, if my amount was, let's say, 2.1 million, I would have been able to take a maximum of 1/3, which happens to be 700,000. So I've taken 500,000 rand. In terms of the law, the first tax law, the first 500,000 rand is tax-free, so all of it is received tax-free. I can then settle my bond, settle my car installment, anything that I owe the bank 100,000 rand, I can use that money. That is what it's meant for. The remaining amount, the 1 million rand, I would then invest it. I don't have to invest it with the same pension fund company or, for that matter, the same retirement annuity company. I can scout and get the best rate in the market. I then start to get income on a month-to-month basis. That income that I'm going to get is annuity income, perhaps for the rest of your life. That would be treated like a normal salary. So you would get that in the form of a salary, and you will pay tax at your marginal rates as though it was a salary. As far as provident funds are concerned, the rules are going to be soon changing. Remember, a pension fund and a retirement annuity follows the rules of the fact that when you retire, you can take out up to a maximum of 1/3 in cash. The remaining 2/3 must be reinvested in a compulsory, what they call compulsory funds, which will give you income in the form of an annuity. In the case of a provident fund, you can take your full 100%. So in my example, if it was in a provident fund and I retired, I could take the full 1.5 million rand away from the provident fund. The tax consequences of that is different, but I could take the full amount and go and reinvest it in another retirement fund. I would pay no tax on the full amount that I've transferred, because that's the full amount that is being transferred. Or I could take out 1/3 of that amount. Again, it will then follow the income tax rules, and it will say the first 500,000 rand of that lump sum will be tax-free. Or I can take the full 1.5, don't take the 500, and then effectively then start drawing a higher annuity. That annuity will be taxable in my hands. So the normal rules, you're allowed to commute the full lump sum at retirement. You can change, the rules are going to be changing from the 1st of March 2015. In the case of a provident fund, you're no longer allowed to take the full 100%. You have to follow the rules the same as a pension fund and a retirement annuity fund. So the remaining, what will happen going forward from the 1st of March, you're going to find any contributions that you make to your retirement fund post 1 March will have to follow these new rules, which means that you're only allowed to take out 1/3 in cash, the remaining 2/3 must be reinvested. As far as the annuitization rule applies in respect of those vested funds up to the 28th of February or the 1st of March. So if you've been in a provident fund all along, the old rules will apply. So you're still allowed to take up to the 28th of February whatever you've accumulated in a retirement fund called the provident fund. That will, you're allowed to take the full 100%. It's only that happens subsequent to the 28th of February, which is effectively from the 1st of March. These new rules apply, and therefore on that, those contributions together with growth, you'll only be allowed to take out 1/3, a maximum of 1/3. The remaining 2/3 must be reinvested. Okay, whilst you're in your retirement, what are the different types of annuities that you can draw from? In other words, the income annuities that you would receive. You can either get a guaranteed annuity, or you can get what we call an investment-linked annuity. So those are the two types. In the guaranteed annuity, the income is guaranteed for life. The retiree is going to take no risk on the investment. However, the guarantees are provided by somebody, which is the insurance company, but you pay for those guarantees. In an investment-linked annuity, you're not getting those guarantees. Retiree takes the investment risk. Retiree could outlive your retirement savings. That's always a problem. So if you look at the second one, which is an investment-linked living annuity, the retiree selects selects the underlying investment fund. The growth is within the fund. There's no tax implications. So if you've been buying 1 million rand, in the first year I draw nothing from it, there are no tax consequences for me. The investment grows from 1 million to 1.1 million, the 10% return. That 100,000 rand that it's grown by, it's not taxed within my retirement fund. The moment I start drawing from it, whatever I draw, I'm allowed to draw between 2.5% and 17.5% of the capital. Whatever I draw, I will pay tax on, because that's regarded as a salary and it is taxed. So the retiree pays tax on income drawn, but not on the growth within the fund. Retiree may outlive the investment. We always recommend retirees should ideally draw less than 5% at first, and then thereafter increase it by inflation. Hence I was saying to you, you've got to have a good, you've got to, that risk spectrum diagram that I put up, how important that is. Because if you have too little capital when you retire, you're going to be drawing 10 and 15%. In the meanwhile, within the fund, it's growing at 5 and 8%. And you're going to be way short when it comes to ultimately. In fact, you'll probably end up in a situation that you'll have life left even after you've run down your full retirement savings. So the retiree may outlive the capital in an investment. So that's why we're suggesting that you draw a very little amount initially. The residual capital distributed to beneficiaries nominated upon the death of the retiree. So he will nominate beneficiaries, and the money would then go to them. In the second type, where it is guaranteed, you could get level ones, where you get a level annuity throughout your life, but that doesn't make sense because inflation is not considered. Escalating one, perhaps it's good. You get an inflation-linked one, so it keeps on increasing with inflation every year. You could get a joint and survivor annuity. In a joint and survivor annuity, it means that first it will come to you. Let's say if you're the husband, upon your death, it will then go to the wife. And then upon your wife's death, you lose the capital altogether. So that's the other type. You could have what we say guaranteed and then for life annuity. So it could be guaranteed for a period of 10 years. So if husband and wife die within the 10 years period, it will be continued to pay to the other beneficiaries in your family, your children, for a maximum period of 10 years. But if you outlive the 10 years, then remember the guarantee falls away upon the death of husband. In my case here, clearly that annuity will stop paying. With profit annuity is another type as well, where the pension increases based on investment market returns. This is becoming popular as well these days. Guaranteed annuity has no residual for distribution. So in other words, the moment you pass on, and if the other rules apply, well, effectively what it means, the annuity falls away. So you lose your 2/3 capital. So certainly here you have that loss. Common errors that people make in their retirement planning, they don't preserve their retirement savings when they're changing jobs. Now that's very important. You know, unlike 25, 30 years ago, when you started on a career, you joined a company, or you joined whatever job you're doing, by and large, people retired in that job. Did you know that things have so dramatically changed now? that on an average, they're saying that people change jobs every 3 years. So what happens is that every time you contribute towards a retirement fund, you change your job, you get 100 grand, and then you say to yourself, hell, to hell with it, 100 grand, I'll pay the small tax, rather use that money to buy a car or buy a better car or whatever. It's not going to appreciate in value. It's amazing how those little amounts actually add up. And if you take the compounding factor of interest and growth, that amount can be substantial during your retirement, but you've lost it. Not monitoring investment returns, which has now changed. Not saving enough for retirement during your working life, also important because you're not tracking. Contributing to retirement funds not based on your entire income. How important is this? Many people go into this mode of saying, I want to structure my package so that I pay the least amount of tax. But in terms of the pension fund rules, what do? They say pensionable emoluments is defined net of all these benefits. So your car allowances and all of that, it's net of that. And I've seen people structure their packages 60%. They get in cash and 40% in perks. And what is your pension based on? Not 100%, it's based on 60%. And when you retire, you get a shock of your life because you take your 100% salary and you compare, you've been contributing for only 60%. And that's quite a serious issue. So your receipt of your non-cash remuneration in the form of perks and fringe benefits is not taken into account as part of your retirement. And hence, when you retire, you're going to have a serious issue. Questions to consider when you're retiring: what are my expected liabilities and commitments at retirement? Will my income meet my lifestyle expenses? Has tax and inflation been taken into account during retirement? Has medical expenses been taken into account? Remember, I spoke to you about this. Often people start using the medical aid when they get into their 60s. But many people don't have medical aid. Or if they go and buy it, it's very expensive. So you have to have your medical aid in place. Has retirement planning been considered for both spouses? This is another very important consideration. Many people, because you come from a wealthy family, you say, oh, to hell with my wife, she stays at home, she doesn't have to worry, it was all my money. But did you know that a person who's 65, and perhaps now I'm taking it to a very simplistic situation, a person who is 65 years and older, if you look at the tax threshold, in other words, the point where you start paying tax, that happens to be in the region of 105 to 110,000 rands. If you multiply that by 2, that gives you like 220,000 rands a year. And if you divide that by 12, you come to about between 18 and 20,000 rands a month. Now, if you take a simple couple that have perhaps settled all their bonds, that don't have any loans to pay and so on, it is possible for them, for their lifestyle expenses, to live off 20,000 rands a month. Now, can you imagine if you didn't plan for the wife to be the second taxpayer in my example? What would then happen is that the husband's going to get all the income, and more than 110,000 rand, he's going to end up being in a tax situation. So it's so easy to avoid it, but people don't consider it. Have you considered planning for your retirement? Makes you think, doesn't it?